Peter from restaurantcompass.com. Welcome to my channel. Today I want to create with you a financial model to start a restaurant. So if you think about starting a restaurant, then this video is perfectly for you. In this video I'm gonna show you how you can use this Excel tool. This Excel tool is called the Customer-Centric Financial Model for Restaurants. It's developed by me, Peter, and produced by Restaurant Compass. That's my small publishing company. And today's headline is how to set up a financial model to start a restaurant. By the way, as you hear probably, I'm not an US native speaker or from Great Britain or from Australia. No, I'm from Austria, so that's not in Australia. We don't have kangaroos. We have a lot of mountains. Well, yes, I do my best. I try my best with my English. Please be patient with me. It's not the best, but I think it works and it should be enough to, to help you creating this Excel file. Okay. So as a start, I would like to give you a little overview. This is the Excel tool I created. This one is already populated with some example data. We will start from the scratch with our new example. So let's start with it. I put this away, and here we have a brand new file with no data entries already inside. So before we start with the Excel file, I would propose that we write down some of our assumptions. First, we work with this tool, the Customer-Centric Financial Model for Restaurants. That's this Excel tool. Second, it's the question how we would like to do our marketing. Means this should be the answer to the question, how do you get customers into your restaurant? And the main focus in our example is that we build on passers-by. So we need a location with some frequency of passing people, and we add email marketing to enhance our customer frequency. The next, we need some basic assumptions how our restaurant should look like. I'm thinking about something like a quick service burger restaurant. Let's imagine we already found a location where we could start this new quick service burger restaurant. And let's say the rent is $3,000 per month. I'm just writing this down. This is a simple Word document here, and this is not already a data entry, just like a notepad. So then the next question is, how many passers-by can we expect per day? Let's say we do have a good location with a quite high frequency of 7,000 people per day. The next question is, how many seats does the restaurant provide? Let's say we do have 30 seats. Then about the opening days, how many days do you intend to keep your restaurant open? Let's say we start with 5 days per week. So the next one is dwell time in minutes. This is already about customer behavior. And the question is important for capacity and utilization and for the sales that are able to make within your premises. So if we think about a quick service burger restaurant, let's guess that our customer dwell time is on average 40 minutes. Next question, main service time shift 1 in minutes. Sounds a little complicated, but it's quite simple. Main service time means the rush hour, the time during the day when you make most of your business. That's quite typical for restaurants because we humans eat our lunch at lunchtime, our dinner at dinner time, and the other time of the day we do something else. So all the people come quite at the same time, so we do have some rush hour. It's the same like the traffic jam in the morning, it's the same rush hour in the restaurant. So you should define for shift one means why shift one? Because there is in this tool, customer-centric financial model, you can also calculate and plan a second shift. Because if you do have a location with high passerby frequency, you probably want to use the whole sales potential, and therefore you probably will need a second shift. But just let's start with one shift to keep the things as simple as possible for the beginning. And so we define the main service time for shift one in minutes. So let's say our main service time is lunchtime, and it's, let's say, from noon, 12 o'clock until 2 o'clock, so that's 2 hours, and 2 hours are 120 minutes. So we know our main service time for shift 1 is 100, has a period, a duration of 120 minutes. Okay, next question is already about email marketing. The question is how many email messages you are going to send per month. Email messages to your subscribers from your email list. If you start from zero, that's okay. Most businesses and quite every channel starts somewhere from zero. Every email list starts somewhere from zero. And we just begin to collect emails from the incoming guests, from the passing by customers. So the question is still, how many email messages are you intending to send out per month? Let's say if you keep open 5 days a week, and that would be about 20 days per week, 20 days per month. So let's say you are going to send one email per day, because we don't want to overwhelm our subscribers from the email list, but also we want to stay in their mind. So let's say we are sending one email per day. Of course, you can also send more per day. It depends on your strategy. But let's say we are going to send 20 email messages per month. So that's about one per opening day. And finally, about the price point. How much do we estimate just for the beginning? Of course, you can change all your data and try different scenarios. Just let's think about how much our customer, how much is our typical customer going to spend for one meal, and we say, okay, about a burger, we are planning $12 for our burger. And how much is he going to spend on the beverage? And let's say $3 for one beverage. So we do have some basic assumptions to start with our financial model. Of course, these are not all assumptions, there are much more details, but we already made our mind and do have a rough plan. So now I'm starting with you to populate this financial model with data. I would like to give you a little overview first. This model starts with the cover here, just a nice cover to look about and with some basic information. Then this is the summary sheet. The summary sheet shows some core financial data and marketing data. The next one here, the red one, is glossary. Well, as the name says, it contains a glossary and description of more than 100 various terms that are used within this financial model. If you do have a question, what does AR mean? Go to the glossary, look for AR, and you find, okay, it's accounts receivable, and so on. Okay, so then there are 8 sheets that are marked yellow: business, marketing, conversion, pricing, personal cost, investment and depreciation, and financing. These 8 sheets are your assumption sheets where you can put in your personal individual data. we will start with this in 1 minute. Then the green sheets, that's location, passers-by, email, social, ads, customers, sales, income, cash flow, and balance. These are the output sheets. So after you put in your data into the yellow fields, into the assumption sheets, you get a lot of output data you can analyze and think about and then optimize your system. And this Excel file also contains 2 extra bonus files that are not interconnected with other sheets. That's recipe and costing. So they are marked dark yellow. These are not interconnected. But all the other sheets, they are interconnected and especially the output sheets. Okay, so let's start with our inputs. We start with a business. And within business, we see the first question is about rent. Just the general information when you buy this financial model, you can buy it, by the way. If you're interested in buying it, you find a link in somewhere around in the description. You can buy it here on this platform, eloquence.com. That's a great platform for Excel tools and so on. And I'm also a registered author there. And you can get a free PDF demo version. Just download it. It's for free. And if you like it, you can buy it here for $290. Okay. And if you want to have some information about my further products, books and tools, I published some books in German and in English too. That's Profit, the Restaurant Owner's Handbook, and Business Plan to Start the Restaurant. They also contain little Excel tools. They are much simpler than this one, but they are also quite helpful if you think about starting a restaurant or if you also already run a restaurant to increase your profit. And you also find articles and infos about running and starting a restaurant. That's restaurantcompass.com. Okay, so now let's start with putting in some data. So for your information, the sheets are protected, but there is no password protection. That means you can easily unprotect it, and if you want, you can make changes to your sheet, so you can individualize the whole model if you want. But just for starting and working with, it's much more comfortable when the sheet is protected, because then the formulas are also protected, and you can't make a huge mistake to the formulas. And by protecting the sheets, you can just jump from one yellow input field to the next one, and it's much more comfortable. Okay, so now let's start with our model. We decided that the rent is $3,000, just put in $3,000. And as you see, as soon as you start to put in your data, the model begins to start, and we already have a loss of $36,000 for our first year. This field shows your net profits, the net income for the first 12 months, means your first year. You have this info field about your profit from the first year on all the input fields. So you always see how your new assumption or a new input impacts your profit. Okay, next one is the question passers-by per day. We decided that this location has a frequency of 7,000 passers-by per day. Then how many seats? We have 30 seats in our restaurant. This is also very helpful to know, because the number of seats limits, of course, the capacity, how many guests you can service, and the system also calculates this maximum revenue ceiling. So the system knows if you have 30 seats, you can only make the maximum sales, and for 30 seats, and the system also calculates this cap of maximum sales. We will see this later. So opening days are 5 per week. The dwell time we decided is 40 minutes on average, and the main service time is 120 minutes. So shift 2 we leave blank for now. And there are also, of course, some additional inputs we can take and make for the income tax, let's say for example 20%. The sales reduction during M1 means we can consider the pre-opening phase, which means when you start to rent your premises, you probably will need some time to prepare it, to put in all the furnishings and equipment and so on. And let's say you need 2 weeks from the first month for pre-opening phase. That would be about 50% of month 1. So we can calculate also this sales reduction, because within these 2 weeks you won't make any sales as soon as you're preparing. So that means the sales reduction. Then the next 3 are relevant for your cash flow. That's the inventory turnover ratio, which means that's the ratio between the value of your inventory, your stocking for food and beverage, and the sales you make. As you see here, I also put in some commentary. When you click on an input field, that helps you with benchmark and explanation to find hopefully realistic and helpful input. So the benchmark for this is about 10 to 25%. Let's say we do have 15% ITR. Next one is accounts receivable percent of sales. Let's just assume 6%. Next one is accounts payable for sales. Benchmark 5 to 15%. Let's say we have 10%. We can also consider alternative locations, because mostly if you think about starting a restaurant, you probably not only have the choice for one location, maybe for 2 or 3 locations, and you maybe probably think about which one is the best one, which one brings me the most profit, the best cost effect, which one is the best cost effective location. Therefore you can put in 2 alternative locations to make them comparable. We come to this in another place, in another video. Okay, that's for this one here, business. We go next to marketing. As you see, you can navigate either here on the bottom with the sheets, or you can use the navigation bar here on top. Both is possible. So we already put in some data into the business sheet. Now we go to marketing. As we decided in our assumption, we are planning to do email marketing. You can also plan social media marketing here in this tool, online search ads, flyer marketing, and direct mail. That's letter, marketing by letters. And you get here an overview of the monthly marketing cost. So we just focus in this example on email marketing, and we start with the question of what's the opt-in rate. This means how many people that are coming into your restaurant and are becoming a customer of you. These people you can ask, hey, I would like to invite you to subscribe to our email list to keep you updated and so on. And some people will say, hey, yes, that's great, I want to subscribe. And some will say, no, thank you. And the amount of yes you get is the opt-in rate. And so we assume that 1 out of 10 will say, yes, great, I will subscribe. If you're good at this, you can reach a much higher rate, but let's stay precautious and just assume a lower rate of about 10%. The next question, email messages per month. We decided to send 1 email per opening day, so that's 20 emails we are sending to the list. Then cost for email system per month. If you intend to do email marketing, it's very recommendable that you use a professional email system. This doesn't mean that it has to cost a lot of money, but you probably will have to pay some little fee. Some providers, as soon as I remind, I think it's MailChimp. also provide free accounts for, I think, up to 2,000 participants from the email list. So you can even start this email marketing with a very low or zero budget, referring the system. But let's say I spend about $50 for my email system per month, and that's a great system. I'm using, for example, GetResponse, and you should budget some money for this. So the next is the cost for writing one email. So someone should or must write the email, prepare the email. You can do this by yourself. You can find some freelancer to do this job for you on Fiverr or wherever, and you should budget some cost for this. Let's say one email is worth us to prepare a really professional, nice looking email of $30. Then we can decide to promote 100% on-premises, means all our emails would promote the customers to come into our restaurant and make sales on-premises. You could also decide to promote a part of your emails takeaway services. We just keep it simple at the moment, and we stay with on-premises. Then email churn per month is the point. The question is, how many customers from your email list that are subscribed to your email list are you losing per month? Because not everybody will come back to your restaurant for whatever reason. He's moving away, or he prefers some other restaurant, or whatever. And you should also you should not only calculate to build up your list, but also to losing some of your customers. So that's the churn rate, and let's assume about 3% per month from your email list you are losing for whatever reason. And if you already have an email list of, let's say, 200 people and you can send to, then you can put this here in, and you already have a little list to start with. Okay, so that's our marketing at the moment. The rest we will leave blank, and we move on to the next sheet, that's conversion. And here you see for this example we focus on premises, and we leave out takeaway at the moment, and also the delivery apps like DoorDash, Uber Eats, or Grubhub. That's too much for this example. We just focus here on our on-premises business. So you see, you can put in here the conversion rate. And what does it mean? Conversion rate means how many people from the passers-by are becoming your customer. Let's say 100 people pass by your restaurant, and 1 of 100 becomes your customer, then your rate is 1%. 1 of 100 is 1%. And the question is now, what's your conversion rate for your location? To help us with this, there is a study about restaurants, and the results, the most important results from this study, I put here into this commentary. And as you can see, bakeries do have a conversion rate on average of 3.4%, confectionery 0.9%, restaurants 0.8%, fast food restaurant or coffee shops 1.1%, and takeaway 1.4%. So as you see, a full restaurant has a little bit a lower conversion rate, and a quick service or takeaway do have a little bit higher conversion rate. That makes sense. And if we think about a quick service burger restaurant, I think we are somewhere between a restaurant and a fast food restaurant. So let's assume we do have a conversion rate of 1%. Okay. The other we leave takeaway, we leave just blank at the moment. And we also decided to do email marketing, and there we also can put in a conversion rate. And I would say also a conversion rate between 1, 2, or 3% is reasonable and possible. It depends very much on how well your email messages are crafted and how strong the relationship is that you can build up with your customer. But let's say, let's stay down, and we assume a 1% conversion rate for email. So the other marketing possibilities we leave just blank, and as we see, our system already gives us some customer data. So we know from this from the passers-by and from the conversion rate here that on average we will have 70 customers per day because of our passers-by, and additional 7 customers per day because of our email marketing. And that's just for the beginning. Okay, so far for conversion, we move on to our next assumption sheet, and that's pricing. And also we focus only on on-premises pricing for this example to keep it as simple as possible. So we start upsell percent. Upsell percent means if you if you're a smart restaurateur, then you know about the power of upselling and that you need a strategy to provide further offers to your customers which are of higher value. So therefore you can increase your sales dramatically. And we just leave it out for this moment. We can come back later. But for example, you could say you are successful with 20%, means through your upselling, you can increase your sales by 20%. But just leave it blank in this example now. So now we start with customer behavior. And the question is, how many meals does one customer consume on average? And we make it simple for the beginning and say 1 burger per customer. How many beverage does a customer consume on average? Keep it simple for the beginning, 1 beverage per customer. Then price per meal. So our price point we already thought about. We know it's $12 and the price per beverage is about $3. Then we come to COGS. COGS food and COGS beverages. COGS means cost of goods sold. And we do have COGS for food and COGS for beverage, and you can put in this number in percent of sales. So this will be a question in detail for pricing and costing. But we just assume a realistic value for food of, let's say, about 27%. And for beverages, let's say of 70% or something like that. Yeah. For food, you have to think about COGS between 20 and 30%, and for beverages between 10 and 20%. These are realistic reference values. Then there is a topic that's shrinkage and theft. And that's a point very few restaurateurs seriously think about and also seldom put into their budget. But it's a point that's realistic and that's on point. You should calculate shrinkage and theft into your budget. And at least I would suggest that you calculate 10% shrinkage and theft, because some food will just diminish, some will be stolen and so on. So 10 to 20% is a realistic number. We just start with 10% now. Okay, so with this we get true COGS for food and beverage. So we know that our true COGS is 27.5% for all, for food and beverage, including shrinkage and theft. Okay, so now we have our basic assumptions, and you already see our net income shows $133,000 in profit, but please consider we are not finished yet, because we don't have put in any cost besides the COGS. So this is not ready yet. You must finish all your assumptions, and then you can have a realistic look at this number. Okay, let's move on to personnel. So here in this sheet we can put in first on the left side here some basic assumptions about how efficient your staff is, how much work it takes to prepare a meal and so on. And here on the right hand side we can put in the staff. the amount of employees that we need. Let's start here with these basic assumptions. Kitchen time per meal, MST minute. What does it mean? In basic terms, it's how long does the cook need to prepare one meal during rush hour? Means how long does he need to prepare one burger if you run a burger restaurant? And if you're well organized, he can do this job in, let's say, 2 or 3 minutes. And if you're bad organized, it will take much longer. And in this figure, the kitchen time per meal, MST, this only includes the time the cook needs to prepare the meal during the MST. It does not include the preparation time before the rush hour. So if you're a well-organized restaurant, then you will prepare a lot of steps, preparation steps, cooking steps, and during rush hour you only finish the meal. So that's the reason why you are able to have short preparation times of, let's say, 2.5 minutes on average. It will depend absolutely on your concept, on your recipe. What are you? What's on your menu? How many items are on your menu? The more items, the more difficult it becomes for you. The lesser items, the better you will be prepared and organized. The more efficient will your staff become. The quicker you will be able to finish and prepare meals. So next one is service time per meal in minutes. This is simply how long does a waiter need to service one customer with a meal. And this also includes the order taking, the serving of the meal if you do have a full service restaurant, and the payment. And let's say this takes on average 3 minutes. Next question, service time per beverage in minute. Let's say this takes about 2 minutes. And then the service time per T&D customer, that's a takeaway and delivery customer. We're not interested in this right now. In this example, we will do a further video, but not now. So then we have customer shift 1 is 100%. Means if you only plan one shift, then put in here 100%. If you want to plan a second shift, then you can put a part of your customers into shift 1 and a part of your customers into shift 2. Let's say both shifts would have about the same amount of customers. So it would be 50-50. You put in the amount, the share of shift 1 of customers here in this field, but we just stay with 100% now. Okay. So then our employees, of course, need to earn some money, and here we can enter the salary per month. I just put in some figures out of my head. A manager, $3,500 per month. A cook full-time, let's say $2,500. A cook part-time, $1,300. A waiter full-time, let's say $2,200. A waiter part-time, let's say $1,200. Okay, these are just example numbers, of course. So now we have the basic data for our staff, and now we can put in the employees for each month. So you see here M1, 2, 3, 4 to 12. That's our first year, and we can put in certain amount of employees for each position and each month. So this allows you a detailed planning of your personnel. So let's say we plan a manager. You also could leave the manager out if you are working yourself in your business. But let's say we plan a manager. We put in one manager for each month. Then we come to shift 1. You can move with your mouse or with the keyboard as you prefer. And you see here for your information, we have the the probably amount of customers per day. So we see month 1, 71 customers, 72 and so on. In month 12, we already expect 84 customers per day. That's because of our email marketing system, which is running in the background. We are generating more and more customers that are coming back more and more often. And so we are gaining more customers month after month. So now we need some cooks to prepare the meal, and let's start with one full-time cook. And what happens? As you see here, now the model calculates the utilization of the cook, and it tells us 147%. Means he's overwhelmed. It's marked red, and that's too much for one cook. So we will probably need a second cook. Okay, so it's green now. The option you do have is to say, okay, I take one full-time cook and one part-time cook, because that's two cooks during rush hour. And maybe if this is possible for you, then you could save some personnel cost. So let's stay with this model. We put in one full-time cook and one part-time cook for the beginning. And we see everything is green. We have two cooks, and this should be possible. Also, if you think just about it, 70 customers, that's possible with two cooks during rush hour. That's doable. So then next one, as we provide service, we need waiters, and we start with one waiter, and we have the same result as with the cooks. We do have a utilization of 294%. That's of course much too much. They are overwhelmed. It's not possible. We put in 3 and we got it. So we could try 2 full-time, 1 part-time, and we tried for the beginning. Okay. Oops, I mean 2. Okay. Okay, so, and we see now they are a little bit, utilization is a little bit more than 100%, so they will be quite busy, but that's somehow not still possible, I think. It will be stressful. Maybe you could optimize here. Let's say if you can shorten service time and so on. You see, this changes a lot, but let's stay with this for the beginning. And we already do have 1 shift. You can repeat this for year 2 and year 3 also, also for shift 1 and shift 2. But in this example, we just put in the data for year 1. It would be the same like for year 1, for year 2 and year 3. Okay, so we do have some assumptions for personnel. Let's move on to costs. And we see, okay, we need, okay, let's start here. Payment processing. Here is about the sales paid by debit and credit card. The point is about 80% of sales are paid with debit and credit card. We assume this number is also in our case correct. So the question is, how much does it cost us? On average, you have to calculate processing fees of about 2 to 4% of sales. So we assume 3%, and we see it will cost us per month $581 only for credit card processing. But okay, that's it. Then we put in some numbers just out of my head for electricity, gas, water. These are just any numbers. I don't really think about it much now. Just some example numbers. Insurance, okay, we buy insurance. Here maybe 50. Okay, and operating costs. These are all numbers per month. These are suggestions. Of course, you can put in your own operating cost as you like and want to prepare. I just put in some numbers. Cleaning will be probably more. Laundry, music, equipment, POS system. Okay. Office supplies. Yeah, we will need some supplies. Telephone, travel expenses, lawyers, hopefully not so much. Consultants, probably a little bit. Equipment repair, there's always something to repair. Leasing for equipment, whatever. Okay, so we do have some operating costs. And we already turned red, but don't worry, this is just a first setup and we are not finished yet. So next we move on to the next sheet, that's investment and depreciation. And this one is the place where you can put in all the equipment you need to set up your restaurant. I make it easy and short here. Equipment, I just sum it up and I guess that we are spending $150,000. So now we have a total investment of $150,000. Of course, you can do this in detail and write the fridge and the oven and whatever, and put in the price and the useful life. We also need the useful life. Useful life is the period of time that you can use this equipment. And let's guess we can use this equipment for 7 years and then we have to replace it with new one. And this results in a depreciation of $21,000 per year and $1,786 per month depreciation. Okay, let's move on to financing. We need some money to start our restaurant. And yes, you have two financing sources you can consider here in this model. One is cash, that's your own equity, the money you already own, your own as a business owner, your money that you have, the equity. Let's assume you have $50,000 in cash, and okay, there's an eloquence message. How nice! And the next one is a loan. Maybe you want to take up a loan of, let's say, $150,000 per month. Okay, so that would be a capital of $200,000. You can put in the interest rate, let's say 8%, and the term in years. How long are you going to pay it back? Let's say 8 years. And then you get a detailed a loan calculation of the payment per month. This loan would have a monthly payment of $2,099.28, monthly interest rate 0.64%, and total interest paid would be $51,530. You also get the monthly interest rate which changes from month to month, because at the beginning of a loan you're paying more interest and it becomes less and less. And it's reverse for principal. At the beginning you pay less on principal and more on principal as time goes on. And the system also calculates the balance, how much you're owing to the bank. So now we have a first basic model and we can review it. Let's have a look. We see this is the output for our location, rent and so on, but we don't have a comparison in yet. Now we are moving on. We see, passers-by. On average, we are calculating with 2,046 customers on premises per month, and a contribution of $22,251 per month. This would mean a return on investment for the rent of 742%, which is not so bad at the beginning. Then here on email, the email sheet gives you an overview how many customers you generate through your email marketing. And you see it's also monthly, month 1 to 12 and so on, and also year 2 and 3. And you start with your list size. You already have a list of 200 people at the beginning. You also can start with 0. And this list grows because the customers that are coming in, the passers-by, are also becoming subscribers to your email list, and so your email list grows. You do have a monthly growth, and here's the churn rate. And you see the sent emails you are sending out to your list every month. We are starting with 2,000 and so on, and 6,000 because the list grows and so on. And we see the effectiveness. About 1% of emails, of the sent emails generate customers, means 6,000 sent emails will generate 60 customers. And the cost for one customer on premises at the beginning, as long as your list is small, with 200 participants, you pay $16 to get one customer into your restaurant. As the list grows and becomes more and more effective, the cost per customer falls. So you see, in month 12, you only pay $1.55 for one customer instead of $16 at the beginning. And we also can get the contribution. Contribution in this case means the sales a customer makes minus the COGS, the cost of goods you have to pay, and minus the marketing cost itself, in this case the email marketing cost. And finally, the system tells you your return on investment. Okay, social we leave out, all the other we leave out. Then you have the sheet customers. You see, how many customers are you getting per month, and how is what's the occupancy of your premises? Is your restaurant full, or do you still have capacity to improve? And here we see that at the beginning, our occupancy on premises is 39%, comes up to 80% and 93% in month 1. This means we are close to 100%, and I want to show you a little view into the future. And as you see, as the occupancy reaches 100%, then you can't get any more customers on premises because your restaurant is simply full, and the system also considers this. And it shows you the amount of customers you are losing because you are full. This gives you a hint where when you reach your full capacity, and it opens you, or it should encourage you to find solutions to enlarge the capacity. Maybe you can put in more seats in your restaurant, or you can shorten the dwell time, or whatever. There are different strategies possible, but the system tells you as soon as you reached full capacity and it does not count more sales than you can make because of your capacity limit. Next sheet, output sheet, is sales. This one shows you how much sales you make in each area. These are on-premises, so we just did this example for on-premises, yet you could also do it for takeaway and for delivery apps. Up to 3 delivery apps, you can choose 3 names, as examples are in at the moment DoorDash, Uber Eats and Grubhub, which are in the United States the most popular ones, at least at the moment in 2021. And we see, okay, our sales on premises at the moment, as we calculated it, is on the start 11,000 and then 23,000 and so on, and grows up to $27,000 per month. COGS is also calculated. We see it grows from 3,100 in the first month. That's just a half month because of our pre-opening, and then comes to $6,500, $7,500 and so on. App fees are none because we don't use apps right now in this example. Next one is a part of the 3 statements. The 3 statements are income, cash flow, and balance. And income shows you your profit and loss. In this case, we do have a loss. And this means we have to improve our model and find a better way to generate a profit and the two possibilities are to make more sales or to reduce your costs simply. And you also get Ebitda, which means is gross profit and the net income after tax, depreciation and interest. And you see the system also uses the exact amount of interest you are planning because of your loan. And the system also gives you a break-even sales number here on the downside. On the bottom, BE sales means you need $27,511 in the first month to make break-even. You just made 11. Okay, that's a pre-opening phase. Then month 2, 27,905 for break-even. Actually, it's planned 23,000. So we need more sales. And you also get the numbers for year 2 and 3. Here's already a profit shown. Why is this? Well, because we are running an email marketing system, and because of this, our customer list grows and grows and grows, and of course, this will become more profitable. But that's not the only reason for this example yet, because we didn't have already put in our personnel, which is a huge cost position for the years 2 and 3. Okay, let's come back to income here. So at the moment our system shows a loss. Then we also have a cash flow statement. The cash flow, of course, should be positive, means how much cash do you have each month to pay all the bills, and this cash flow should be a positive one. If it's negative, then it's marked red. And finally, the balance. And the balance must have a very simple fact. It must be balanced, means the assets on one side must be equal to the sum of liabilities and equity. Means total liabilities and equity, in this case 185,635, must be equal to the assets in month 1. Assets and liabilities and equity must be equal. And you do have a balance check here on the bottom, and if this says okay, then this balance is correct, means these numbers are equal. The balance is balanced. If this is red and it shows a special number, a certain number, then something is wrong with your balance. As long as you don't change the model, it should always be okay. If you do start to make changes with the formulas which are not correct, then this could become red and warn you about a wrong balance. But as long as this is green, you know, okay, the balance is correct. So one hint is that you always need enough cash. As we know, as entrepreneurs, we always need to be able to pay our bills. And you see this here in your cash balance, current assets cash. You see, okay, at the beginning we have a lot of cash and it becomes less and less. And in month 1, we are running out of cash. It's minus. So that's not possible. Minus in reality, it's possible in the balance in theory, but in reality you can't have negative cash. Means here you are broke, so you need to do something before you are getting broke. And so we go back to our input sheet. That's the way how you set it up at the beginning, and then you start to work with the model. And you start to try different things. So now let's say we go to marketing, yeah, and we go to marketing. We say our email marketing is a little bit better than 1%. It's 1.1%, and we go to pricing, and we say okay. Instead of 27%, we will find 25%, and we have the goal to reach 15% in COGS And we also take measures to prevent theft and shrinkage, and we can reduce this number to 5%. And further, because of upselling, we do implement an upselling program, and we are successful, and we can reach a 25% increase in upselling. And as we see, we are almost there. And we look further, and we look at here within the kitchen time, service time, let's say here service time, we can improve our service and reduce our personal costs. So as we see, okay, now we can save one part-time waiter, and this won't be able, I think. No, okay, this won't be possible. We stay here. Okay, and so you see your income turns positive now, and this is now your job to develop a system that's realistic in all assumptions. You will have to think a lot of all these, every single assumption. You will come back again and again, and you will check the rent. Maybe you find a rent that's cheaper. Maybe you find a location with 8,000 people. Maybe your restaurant has 35 seats. As you see, that's something I wanted to show you. As you see here, now are 35 seats in. Let's say it's just 12 seats. Then it turns red because your capacity is 12 seats, and the system does only count sales that are within the possible capacity. So this gives you the possibility to try different sizes of seatings for your restaurant, which one is profitable. Let's say you have 20 seats. Okay, it's increasing, but still we have a 100% occupancy. On the right hand side, you see it on the overview. O is occupancy on premises, and you find it's 100%. So the restaurant is too small. How about 30 seats? And now we are becoming better, but we are still in month 7. We are 100% occupied. So how about 40 seats? And now it's getting more interesting step by step. And next step could be that you think about takeaway business. We could put in here, let's say 1% takeaway conversion rate. You do have 8,000 passers by, and let's say your restaurant is able to service also a takeaway business, and we assume a 1% conversion rate, also for email. Then we put in some pricing numbers for takeaway. Let's say on average they take away 1.5 meals and 0.5 beverages. Many will take away a second meal for their partner, and many won't need a beverage on the way. And we assume $11 for takeaway food and $2.50 for the beverage takeaway. And we calculate a little bit more COGS because you also need to consider packaging. And we put in a little bit more for the beverages. Shrinkage, we assume the same. And we are also active in upselling. And as you see, our net income increases massively, but also our workload, which we have not considered yet. So this is a very interactive part. Now you need, because you make much more sales, of course you need more cooks too. So we increase our cooks, and we see, okay, we will probably need at least 2 or 3 cooks here, yes, and that's the way you plan your restaurant. And we will probably also need more waiters. So now we are getting closer to a more and more realistic financial model. Well, that's it for the start, I would say. Yes, finally, I would like to finish with this overview. Then you can find here the core financial data, sales, break-even, COGS, expenses, Ebitda, net income, and all this stuff here in the executive summary. You also see which marketing is the most profitable one. In our case, we see passers-by provide a 2,266% ROI, return on investment, email 828%. It's really worth to calculate all the different marketing possibilities you have, because then you can focus your money you have for marketing in the most profitable one. And you get more insights, email marketing, one customers, how much do you make takeaway on premises, and so on. I'm sure this is a very helpful and powerful tool. So if you think about starting a restaurant, either build such a system yourself. For me personally, it took me, years of experience and about 1 month of intense programming, building it on Excel. And you can get it for $290 and start right now building your financial model for your new great restaurant. I thank you very much for your patience. Great that you stayed until the end. If you like this video, please give it a thumb up. Subscribe to my channel. I would appreciate very much. I think about and plan to make more of this kind of videos. Please support my channel, and if you would like to see some special topics of how to create a business plan for a restaurant, just write a comment. I'm interested in, I don't know, personal planning, marketing planning, whatever. Give me a short feedback. I will consider it in my next video. At least I will try to do so. Thank you very much again. Please stay with me, subscribe, and thumbs up. Thank you so much. See you. Bye bye.